Welcome to the new episode of MoneyWorks4me podcast. We are recording this session on 23rd September 2021. In this episode, we are going to discuss about PSU investing, risk and opportunity. And to share our view, I have our equity analyst Ketan with us.
Hi everyone.
Hello. If you had invested equally in 43 PSU stock in 2011, you would have earned 7% CAGR versus 14% CAGR in Nifty 50. If you had removed public sector banks, it would have been 9% CAGR. Still, it was significantly below Nifty's performance. So let me ask you, Ketan, what are the reasons for huge underperformance of PSU stocks?
First of all, PSU stocks in itself is not a sector. So I can't paint the whole space with the same brush. Now there are different business models in PSUs. Some of them are like Gujarat Gas, Indraprasth Gas, IRCTC, which are making new highs every month. And then there are few small banks which are probably bankrupt and might be reduced to zero eventually. So the point you need to ask is whether you would have made a decision to invest in a PSU stocks based on ownership, or you would have made a decision to invest in a business model.
Okay.
So it is true that overall space has underperformed. There are primarily two reasons for the same. Now the first reason that comes to mind is that India has had a slowest economic growth in last 10 years, which is 2010 to 2020. Now during this decade, most of the companies that are economy sensitive have suffered, either from excess capacity or no new capacity addition. And same ways, 9 out of 10 PSU stocks are actually economy sensitive. Just like capital goods and metal sector did not perform in last decade, PSU stocks also did not perform. Now the second reason for the same could be the regular selling done by government through ETF or OFS. Now there are few companies which are operate in industry that concerns ESG conscious investors. Now these are the reasons why there has been a constant selling pressure, and even some of the fund managers have alluded to this fact that such selling pressure in stocks have kept them on the sidelines when it comes to investing in PSU. So these are the two reasons, one fundamental and other being technical in nature, has made this space touch me not in last 3 years.
So do you feel PSU stocks have become very cheap? Because when I look at dividend yield, quite a few of them are yielding from 3% per annum to 8%. How sustainable is this?
Now, whenever there is excessive pessimism or constant selling, the asset prices naturally become very attractive. This was true about pharma sector in 2 years ago and in IT sector 3 years ago. Now similarly, quite a few stocks in PSU space have actually become very attractive. Some of the companies are in sunset industry like oil or coal, which their sales growth itself is indicating that their prospects are dim. But there are few very attractive companies in gas and power space. We are holding few companies in our portfolios. The ones which we are invested in earn healthy return on capital and they generate tremendous cash flows. They are also reinvesting the cash flows for growth. So one has to pick and choose companies based on quality and growth. Shortlisting on basis of dividend yield alone is not going to yield good returns. Now higher dividend yield might be result of falling stock price, or there could be a risk of dividends getting stopped someday. So studying underlying business is very important after screening the stocks by just PE or dividend yield.
How should a retail investor participate in PSU? Is there an ETF or sectoral fund which might be of interest?
Now there are only two reasons why stocks go up. One is that company earns return on capital above its cost of capital, and two, that there is a growth in sales, profits and cash flows. So why would it be any different for PSUs? Now if I put the PSUs in this filter, only few of them make the cut for healthy returns. Now PSU investing is not similar to a pharma or a IT industry where many pharma and IT companies are good quality and most of them were trading quite cheap or reasonable price in like last 2 years. So it makes no sense to buy all PSUs, that they might be trading cheap for right reasons. If one is keen, he can consider Bharat 22 ETF, which also includes ITC, Axis Bank, L&T along with few good PSUs like SBI, BEL or GAIL India. Now most of these companies are trading at very reasonable valuation. I would like to highlight that never go overboard when you find a high dividend yield stock or a cheap stock on a PE ratio or PB ratio. There might be a good reason why they are cheap. If you do find risk reward favorable, invest only a portion of your portfolio in such names. Like we had a limited exposure of 10 to 15% in 3 to 4 PSU stocks, even if they were trading quite cheap. Now, if we are right, we are definitely going to earn very good returns, but it won't cost us much if it doesn't.
In Budget 2021, Finance Minister has taken lofty target for divestment up to 1.7 lakh crore. Recently, Divestment Department has expanded the scope and set a bolder target under Asset Monetization Plan, which is pegged at 6 lakh crore. What is your take on privatization of PSU and Asset Monetization Plan of government? Is there a way we can participate?
I believe it is the right move by the government that assets that are already constructed and earning annuity type of profits. Now these do not have to reside on government's balance sheet. Instead, they must be monetized and the proceeds can be used to spend in areas where infrastructure is inadequate. I expect that these assets will be in form of InvITs, which is investment trusts, which offer high and stable dividend yield. Now these trusts are direct owners of assets and they will be in charge of collecting fees and distributing dividends to investors. To cite a few examples, like gas pipeline or a transmission tower or even highways are kind of assets that earn fixed fee for service and do not need any reinvestment or any deep operational management. We expect that quite a few assets will be sold to the funds which are sovereign funds or pension funds or even private equity investors who are looking for such steady yields. Now there is a lot of demand for yield across the globe because the interest rates are so low in developed countries. Now while these are quasi debt investments, retail investors have many other avenues to earn steady returns. If we find that returns in this space are attractive, we will recommend InvITs in future.
Okay. Thank you for your valuable inputs, Ketan. Just to update you all, we are now live on Google Podcast, Spotify and YouTube. You can subscribe to our channels and get frequent updates like this. Till then, happy investing.